if we look at the spectrum of valuations, okay, so you have here, somebody might want to get a valuation because they just want to know, hey, what's my business worth? I just want to get an idea from a planning perspective. Then they want to get into some kind of a legal contract, maybe, or there's some legal matters that require some kind of qualified valuation. And then at the very top is, we're talking, when I say top, I'm talking about more detailed, is when we're going to go to the service and say, hey, we're going to claim a valuation discount here. So there's a broad range. And some of the stuff that's done, let's say at the bottom end of the spectrum, is often done by folks like me and CPAs, right? Where, you know, some people are using software, other people are using Excel spreadsheets, and that's okay as long as you understand what the limited use of that particular valuation is, right? And so when we're looking at valuations, you mentioned DCF, discounted cash flow model, and there's multiple different ways, and I don't want to get into the sausage making at this point, but when we're looking at valuation, so I'm a business owner, and obviously if I'm selling my business, I want to get the biggest value that I could get so that I could go to the buyer and say, look, here's how much my business is worth. What are some of the variables that you see that greatly impact or have significant impact between two similar companies, one, you know, exact same business, but one's valued a lot more than the other? What are some of the things that you see?
It's typically for most businesses, personnel costs are going to be first and foremost among SG&A. You know, if it's capital intensive and there's a lot of inventory and cost of goods sold, you know, depending on if the company could pass those costs through, you know, you might see some differences. But if we're talking about two companies, pretty, you know, more or less in the same industry, they're probably going to have the same economic factors there. So when it comes to personnel, if there's any rent, you know, if they're leasing their facilities, or, you know, I was going to say leasing or renting, whether they own the facilities or lease them, that could play somewhat of a role. But I'd say overall, it's really just a matter of the management, I guess. You know, it's you have the same economic factor. So at that point, it's really like what's internal to these companies that's making them different. How are they operating differently? How are the earnings margins differently, depending on which set of earnings, you know, you're looking at. And so, you know, there's that, and then there's also the element of you know, I call them the cost of toys, and, you know, your boat expenses and non-operating assets and any sort of expenses associated with those. You know, it can be amazing how much more value the company will have when you look at the owner and say, all right, let's take out the boat, let's take out the hunting lease, let's take out, you know, does the company really use the private jet for, you know, marketing purposes, or like you just want to go to, you know, Monte Carlo for in the week or something, and you know, and when you take those expenses out and you realize, you know, you can, at that point, you could get a true perspective on what are the margins of this company. And it's, you know, if not margins, you know, the cost of these certain line items as a percent of revenue, let's say, and how do those compare to guideline public companies or other companies in the industry? You might look at RMA data for smaller, you know, more privately held companies, which most of our clients tend to be smaller, privately held. We do have some publicly traded companies, some, you know, fairly large ones. But for the most part, business valuation is not, you know, I'm not determining the stock price, you know,
right,
in my 9 to 5 conceptually.
Right.
You know, if I'm looking at equity, I could be looking at, you know, a price per share, but that's kind of the main thing is seeing how that management team is allowing its company to be operated, to see where could we tighten up here? You know, if there was a market participant that came in and bought this company, what would they do differently, and how realistic would that be, you know, versus management's projections? And so that can very much, you know, sway the valuation. You know, it's, if we look at it and we say, there's a whole lot of noise in here, let's clean out the noise, get a true perspective, then we could say, all right, realistically, do you think you could make certain changes? And you know, we have to account for that.
Yeah. Well, what's interesting about that is the savvy owner who is running a lot of their, let's say, you know, has a lot of toys in the business, they'll know that, and they'll say, well, if you know, my company's actually worth a lot more because we got to take this out. Whereas someone who's less sophisticated may just say, okay, well, this is the value, I suppose, and they get hustled by the potential buyer, right? And Jack, in situations where we have a partnership, right? Oftentimes one of the partners will leave before the other partner.
Right.
And oftentimes when you're drafting these buy-sell agreements, there's clauses in there that talks about how we're going to value the business. And so, what Justin's talking about is the method that we use for valuation is going to be important at that time. Now, a lot of times, if it's partners of the same age, let's say, where they're going to leave together, they don't know who's going to leave first. But in situations where you have an older partner that, for the most part, the plan at least is they're going to exit first, they're going to want to negotiate that buy-sell in such a way that benefits them, right? So talk about how, in a buy-sell agreement, the method that we put in there as to how we're going to value things matter.
Well, it can matter a lot. And, I think you nailed on the head, depending on the context of the partnership, could dictate kind of how specific you get. I would say, like, in a lot of situations where you have a bunch of kind of equal, similarly situated owners that are really happy and excited about their business, having the buy-sell conversation can be difficult, or it could be, pretty easy, but they're not really interested in getting into the nitty-gritty. Okay, if you leave, this is the price, but if I leave, this is the price. I mean, usually we're just saying, if we agree, then that's based on whatever the buy-sell trigger is. That's going to be whatever we agree upon. And if we don't agree, then we'll hire a valuation expert to determine what the fair market value is of your interest. And it just kind of leaves it at that. In the situation you were talking about, where it's like maybe there's an employee you're making a partner, a new partner coming in, that situation's a little different, and you might have EBITDA or other metrics coming into play, being more specific about what the buyout price is going to be, depending on how they see the business going and who's doing what in the business. So it can be a very bespoke process. And I think a lot of the challenges as a lawyer and as an advocate for the company or the people involved is to have that conversation early and have it put and documented. So when there is an exit coming up, you have a plan in place to take care of it.
Information contained in this podcast and accompanying video have been derived from sources believed to be reliable. This content is not guaranteed as to its accuracy and does not purport to be a complete analysis of the topics discussed. Analysis is based on assumptions that may not come to pass. None of the content should be construed as legal or investment advice. You should consult with a qualified professional before implementing any strategies discussed. All expressions of opinion reflect the judgment of the speakers on the date the video was recorded and are subject to change.